And we are live. Good evening, everyone. Tonight, we will be discussing how the Fed came out yesterday and had an emergency meeting and did an emergency rate cut of a 0.5 percentage point. This is extremely important that we follow what's happening in the markets. The last two times that the Fed made emergency cuts before the FOMC meeting, the market was then cut in half. They did it in 2001. And they did it in 2007, 2008, right before the market crashed. I want to repeat that for you again. The last two times when the Fed made emergency rate cuts, the market was then, within the next 6 months to a year, cut in half. In my personal opinion, we are living in this generation's 1920s, the roaring 20s, and we are at the tail end of our generation's roaring 20s. Towards the end of the 1920s, we had a crash in 1929, which was then followed by the Great Depression. One thing about history doesn't repeat itself, but it damn sure rhymes. And we are seeing all of the signs and the signals that are pointing to a repeat of the roaring 20s and what's to follow. Hollowing out of the middle class, massive amounts of debt, not just here in the U.S., but globally. We're over $253 trillion of global debt. So it's safe to say at this point, you really need to start paying attention. Now, understand that this is not financial advice. This is me simply sharing my thoughts and my opinion with you. But this is what I'm beginning to see. And in my personal opinion, I feel that within the next 12 months, we are definitely going to see some type of a recession, and followed by what would feel like a depression for some people. And see, what's going to happen is we're going to have some type of a dislocation where what we're seeing right now, where the financial economy, the financial elites, the corporations, the top 1%, they're seeing all of the economic gains and all of the economic benefits. But the middle class is being hollowed out. Our manufacturing base is being shipped overseas or automated, where everyday Americans aren't benefiting from a lot of the innovation and the gains that are happening in the financial economy. So we're starting to see this dislocation, and we're going to further see this because, as I've said to you time and time again, you don't have to have a PhD in finance or economics to see money is debt, and Wall Street is addicted to cheap money. This has nothing to do with stimulating the economy, because in the Keynesian's mind, in the Keynesian world, through Keynesian economics, the only way that the economy can grow is by Americans going into debt. So when they slash interest rates, they want to see you borrowing more money. Now, I already highlighted to you that household debt is already sitting at $14.5 trillion. So today, we're going to dive into the information. We're going to dive into why I feel that we're in the tail end of the roaring 20s. So with that being said, guys, please, as you come in, type 1 if you can hear me clearly. Please like the video. Share the video. If you're not subscribed, please subscribe and hit the notification bell. If you want to be notified every time I go live and every single time I upload a video, please join my mailing list. It's in the description below. Also, please follow me on my Instagram, so therefore you can keep into contact with me and direct message me if you have any questions. I normally respond within a day or two to your questions. Also, if you want to support the content financially, please, the PayPal is in the description below, because some of these videos, YouTube doesn't like to monetize this type of content because they want to control the message and they want to control the narrative. So let's look at the markets real quick before we get started. We can see Bitcoin is sitting at $8,849. Ethereum's at $225 and XRP's at 23 cents. There's nothing else really happening. Tezos is getting a bid. I have a major position in Tezos, but for the most part, for the most part, the crypto market's really just in a pullback phase before it takes its next leg higher. Let's look at what happened in the broader market. Really no movement happening in crypto. The S&P was up 4% today. The NASDAQ was up 3%. The Dow was up 4%. We had over 1,000-point move on the Dow. The Nikkei was up 215 points, 1%. The DAX was up 1%, and the FTSE was up 1%. Let's look at silver. We can start to see that precious metals are starting to get a bid. We can see the market sold off. This right here, this selling that you've seen in gold and silver, let's zoom in so you guys can see it a little bit better. this selling that you've seen, this is what is known as margin selling, collateral selling, where when you're up in a position and you're down in the markets, what happens is you get what's known as a margin call, or you have to put up more collateral to hold those positions. So because the market starts selling off so heavy, and a lot of these big funds, they probably had a lot of money invested in precious metals like gold and silver, and they were up in that position, they had to then sell off that position to raise the collateral to make sure that they had enough money in case they had a margin call. But you can see silver's starting to get a bid. We're looking at a daily chart of the silver futures right now. And then we're looking at a gold chart. And right now you can see gold had that massive sell-off. Gold had this massive sell-off right here. And then look, gold rallied and pushed right back up. So we can expect to see $2,000 gold, $2,200 gold before the year is over. That's my prediction on what's happening in gold. Now, I want to show you something because this ties back into, just follow me here. You don't have to have a PhD in economics. Just follow me. Very, very simple. Debt is money. The only way that the economy can grow is by creating debt. That's what they mean by stimulus. Either the government goes into debt to stimulate the economy, or the Fed creates some program, whether it's TARP, TALF, ZERP, QE, cash for clunkers. All of these is basically debt monetization, spending money, creating money out of thin air to make the economy grow. Well, back in October and in September, we started having problems in the repo market. And I'm going to give you government data. This is not conspiracy theory talk. I'm giving you the straight facts. What happened is we started having liquidity problems in the repo market, and the Fed started creating $100 billion on a monthly basis, $200 billion on a monthly basis to basically put liquidity into the repo market. And look what happened from October. The market slowly went up. And then we had this corona problem that was happening with the coronavirus. And then look, boom, the market sold off. And right now what we're starting to see is a retracement. Why? Because once now the Fed decides to step in, Wall Street feels comfortable. And now the Fed is injecting over $100 billion per day into the repo markets. And we're going to get into that in a second. Now, going back to what I was saying to you before about history. See, history doesn't repeat itself, but it damn sure rhymes. And if you don't believe me, you can go back and look this up for yourself. In 2001, the Fed cut interest rates by 0.5 percentage point. And look what the market did. The market sold off. The Fed cut interest rates back in 2007. Right? Because see, the Fed can see what's happening before it happens. Why? Because they control a boom and bust cycle. The boom is everyone going into debt. The boom is the problem. The bust is the economy healing itself and wiping out all of the bad debt. Well, the same thing happened in 2007. They cut interest rates by 75 basis points. And look what ended up happening towards 2009. The market crashed. And just right now, so that's what we only can go for history. And we're seeing the same thing happen again right now. Now, the difference with today is two things can happen. Because the world is printing money now, right? The G7 countries have all came out and stated they're willing to do whatever it takes to get the economy started again. That simply means they're willing to print as much money as possible. And again, I'm going to highlight all that stuff for you in a second. They're saying that they're willing to do whatever it takes to get the economy running again. That simply means that they are willing to go and print money. So we can see two things happen. We can see a flat out crash and prices just go down, or we can see the market begin to rally because the government, especially like in Japan, the central banks are saying that they're willing to go and buy stocks. Forget buying government debt. They're talking about actually going into the market and buy stocks. So what does that mean? The stock market can go up, but the purchasing power of your dollar will go down. Let me repeat that for you again. If the Fed decides that they want to copy the Central Bank of Japan, and go out and buy stocks and buy ETFs, we can see the stock market rally, but at the expense of inflation, meaning that you'll still get paid, but your dollar will buy less. That's very, very important. And now there's something known as price discovery, where the market sets prices. Supply and demand sets prices. Competition sets the price. But if you have the Fed constantly intervening in the market, you don't know what's overvalued and what's undervalued because there's so much liquidity and cheap money being pumped into the stock market, which doesn't benefit everyday Americans. What you see right here is a definition of price discovery. It says price discovery refers to the act of determining the proper price of a security, a commodity, or good or service by studying market supply and demand and other factors associated with transactions. Well, if the Fed's going into the repo market, if the Fed's going into the Treasury market, if interest rates are dirt cheap and banks are not loaning the money to you and I, but instead loaning the money to hedge funds to go and speculate, then we don't truly know if Tesla's a good company or not, right? Because based upon the fundamentals, yes, Tesla has great cars, but there's no reason why Tesla's valuation should be where it's at based upon the fundamentals. But when everyone's looking for yield because you can't find the yield in the bond market because the Fed is forcing you out the market because they're buying the bonds, well, we don't know what things should cost, right? When you look at Apple, I showed you guys before about record stock buybacks. When the elites, when the financial elites, when the top 1%, when the rich got the tax cuts from Trump, they didn't go out and hire people. They didn't go out and buy more equipment. They didn't go out and do none of the things that they said they would do, investing in people, paying livable wages. No, what they did was they simply went and brought back their stock. So when they buy back their stock, they're artificially pushing up the price. Why? Because markets operate off of a supply and demand. Well, if you take away supply through financial engineering, it's easy to push the stock prices up. But remember, it's a double-edged sword because just like it's easy to push prices up, it's also easy to push prices down because you're taking a lot of the liquidity, the supply out of the market. So if demand remains the same or it increases just a little bit, it's easy to push prices up and it's also easy to push prices down. So we don't have true price discovery and we don't know what's overvalued in this market or what's undervalued, which is why it's extremely hard to trade the market, which is why I simply put my money into things that actually makes sense. Why? Because think about it. They're telling you they want to print money. They're showing you the playbook. So I want to own gold and silver to preserve my purchasing power. To preserve my purchasing power is why I want to own gold and silver. And then I want to speculate in things that I feel are going to go boom and bust. Now, I don't like the stock market. Personally, I like precious metal mining stocks because they pay dividends. And I know that once we get this boom in gold, we're going to see the miners begin to boom. And if you look at the GDX, the mining ETF, we're starting to see that happen now. Now, I want to show you again. Guys, I don't guess when I say this. It says U.S. household debt hits record high, $14.15 trillion. Total U.S. household debt reached a record 14.15 trillion at the end of the year after increasing by 193 billion or 1.4% in the fourth quarter of 2019. According to the Fed's quarterly report on household debt and credit, the report based on a nationally representative sample of individual and household level debt and credit records drawn for analyzed Equifax credit data noted that total household debt is now nominally $1.5 trillion higher than the pre-recession peak of 12.68 trillion in the third quarter of 2008. So now go back to this chart. What happened in 2008 that just happened yesterday? In 2008, the Fed made in 2007, 2008, the Fed made 2 emergency rate cuts. And look what the market did. It sold off. And it made an emergency rate cut back in 2001. And the market sold off. And we just seen an emergency cut. Now, remember, they have the FOMC meeting coming up on the 17th and 18th. And they're already talking about cutting rates again. So we could see a 75 basis point cut in less than a month. That's important to understand. Look at global debt. Right? It says the world's already huge debt load smashed the record for the highest debt to GDP ratio before 2019 was even over. In fact, it broke the record in the first 9 months of last year. Global debt, which compromises borrowings from households, governments, and companies grew by $9 trillion to nearly $253 trillion during that period, according to the Institute of International Finance. That puts the global debt to GDP ratio at 322%, narrowly surpassing 2016 as the highest level on record. I want you to think about that. Global debt. What do I constantly tell you? Debt is money. The only way the economy can grow is by going into debt. So when I hear people talking about, oh, well, mortgage rates are going to be lower, so you can go out and get a mortgage. Well, what good is it to go get a mortgage if your job's not paying you a livable wage, or your dollar, your purchasing power of the dollar is losing value? So yeah, mortgage rates may be lower, but you're getting killed in inflation. So it doesn't balance out. You have to think about it and actually use your brain and understand what's going on. Now everyone's trying to make it seem like, President Trump. I want to show you something, because this is a conservative president, as I've stated before in previous videos. Well, conservatives are all about limiting government spending, reining in the Fed, balancing the budget, right? Picking yourself up by the bootstrap, doing everything the right way. Well, here you're President Trump, who during the campaign trail said the stock market's a bubble because of the Fed. Well, now he says Australia's central bank cut interest rates and stated it will most likely further ease in order to make up for China's coronavirus situation and slowdown. They reduced to 0.5%, a record low. Other countries are doing the same thing, if not more so. Our Federal Reserve has us paying higher rates than many others, when we should be paying less. Tough on our exporters and puts the U.S. at a competitive disadvantage. Must be the other way around. Should ease and cut rate big. Jerome Powell, led Federal Reserve, has called it wrong from day one. Sad. Now, on the campaign trail, let's listen to what President Trump had to say when he was campaigning. And I've played this before for you guys, but I like to, lay the foundation before we go to where we're trying to go.
Mr. Trump,
typical politician, all talk, no action, sounds good, doesn't work, never going to happen. Our country is suffering because people like Secretary Clinton have made such bad decisions in terms of our jobs and in terms of what's going on. Now, look. We have the worst revival of an economy since the Great Depression. And believe me, we're in a bubble right now. And the only thing that looks good is the stock market. But if you raise interest rates even a little bit, that's going to come crashing down. We are in a big, fat, ugly bubble. And we better be awfully careful. And we have a Fed that's doing political things. This Janet Yellen of the Fed. The Fed is doing political by keeping the interest rates at this level. And believe me, the day Obama goes off and he leaves and he goes out to the golf course for the rest of his life to play golf, when they raise interest rates, you're going to see some very bad things happen because the Fed is not doing their job. The Fed is being more political than
I want to replay that for you guys again. I want you to hear the hypocrisy here. And this is why you don't have to I'm going to keep stating this over and over again, guys. You don't have to have a PhD in finance and economics to understand what's going on. They are going to continue to keep printing money because Wall Street is addicted to cheap money like a junkie is addicted to drugs. The only thing that can stimulate the economy is growing the debt. And once you begin to understand that, now you understand why crypto is important. You understand why gold and silver is important because they're not going to stop printing money. And they're doing this globally. There are central banks all over the world. I'm going to replay for you again.
And believe me, we're in a bubble for our jobs and in terms of what's going on. Now, look, we have the worst revival of an economy since the Great Depression. And believe me, we're in a bubble right now. And the only thing that looks good is the stock market. But if you raise interest rates even a little bit, that's going to come crashing down. We are in a big, fat, ugly bubble. And we better be awfully careful. And we have a Fed that's doing political things. This Janet Yellen of the Fed. The Fed is doing political by keeping the interest rates at this level. And believe me, the day Obama goes off and he leaves and he goes out to the golf course for the rest of his life to play golf, when they raise interest rates, you're going to see some very bad things happen because the Fed is not doing their job. The Fed is being more political.
So it's laughable. And this is why I laugh at the Candace Owens, the Brandon Tatums, the Anthony Brian Logans, that whole Brexit crowd, because they clearly are just shills for the Republican Party. Because here he is, he's calling on the Fed to cut interest rates. If the economy was so strong and it was roaring, he's been calling for interest rates to be cut before this virus even happened. Before the virus hit, I have videos going back 6 months, 7 months where he was calling for negative interest rates. And then he says this on the 3rd. Everyone puts pressure on the Fed. That's why I laughed when people said, like, oh, this happened out of thin air as far as the Fed cutting rates. No, the market was signaling for the Fed to do what they have to do to get the market to go back up. And he did this on the 3rd. And then, let's see. Here we go. And the Federal Reserve is cutting, but must further ease. And most importantly, come into line with other countries / competitors. We are not playing on a level playing field. Not fair to the USA. It is finally time for the Federal Reserve to lead. More easing and cutting. So what does that simply mean? More debt monetization, more printing money, more liquidity. Whenever you hear stimulus, easing, that simply means printing money. This isn't complicated. The stock market, when the Fed got into the repo market back in October, the stock market took off 19%. This was a 19% move from when they got into the repo market and started injecting liquidity into the repo market. And again, you don't have to understand all of the technical stuff. You don't have to sit down and look at the balance sheet and look at the Fed. You don't have to do any of that. Just listen to what they say and then watch how the market reacts. And as soon as the market sells off, what do? They slash rates. Now, let's get to the roaring 20s, because this is going to basically tie everything together for you. The stock market crash of 1929. On October 29, 1929, look at the dates, right? They correlate pretty well, but I'm not going to get into the conspiracy stuff. Black Tuesday hit Wall Street as investors traded some 16 million shares on the New York Stock Exchange in a single day. Billions of dollars were lost, wiping out thousands of investors. In the aftermath of Black Tuesday, America and the rest of the industrialized world spiraled downward into the Great Depression from 1929 to 1939, the deepest and longest lasting economic downturn in the history of the Western industrialized world up to that time. What caused the 1929 stock market crash? During the 1920s, the U.S. stock market underwent rapid expansion, reaching its peak in August 1929. After a period of wild speculation during the Roaring Twenties, by then, production had already declined and unemployment had risen, leaving stocks in great excess of their value. Among other causes of the stock market crash of 1929 were low wages, which we currently have today, the proliferation of debt. We have a lot of debt today. A struggling agricultural sector. We have a struggling manufacturing base today. And an excess of large bank loans that could not be liquidated. Doesn't that sound like exactly what's happening today? $23 trillion of national debt. I always show you this chart right here. $74 trillion of total debt and liabilities in the system. $1.6 trillion of actual cash reserves in the banking system. History doesn't repeat itself, but it sure rhymes. Yeah, people have jobs, but they're not paying them anywhere near a livable wage based upon inflation. History doesn't repeat itself, but it sure does rhyme. And I want to read that paragraph for you again because it's very important. It says, during the 1920s, the U.S. stock market underwent rapid expansion, reaching its peak in August 1929, after a period of wild speculation during the Roaring Twenties. By then, production had already declined and unemployment had risen, leaving stocks in great excess of their real value. Among the other causes of the stock market crash of 1929 were low wages, the proliferation of debt, a struggling agricultural sector, and an excess of large bank loans that could not be liquidated. We're watching the same thing happen today. As I said, the difference, though, is now this is global. See, this isn't just isolated to America anymore. We're looking at global debt of right here. We can see, pull this up. Where's the article at? Right? We can see the debt. Look at this from 2012. Let's look at the debt. 210 trillion, 220 trillion, 230, 250 trillion dollars. $250 trillion of global debt. This is happening all throughout the world. And now they're saying they're going to have coordinated stimulus. What does that mean for? This is why. So when you wake up and you see gold beginning to bounce, you're going to see it continuously keep happening. Now remember, the gold global market cap is $8 trillion. That's how much all of the gold, the actual gold market cap is worth. The gold market is worth $8 trillion. Bitcoin's only worth $160 billion. And this is a global currency. So when people say that Bitcoin is a bubble, the stock market bubble just wiped out $3.7 trillion in 6 days. The little Bitcoin bubble, that's tiny. People's pensions and 401ks aren't tied to the price of Bitcoin. You don't have large pension funds investing in Bitcoin. $3.7 trillion of wealth was wiped out in a matter of 6 days in the stock market. It's laughable when you hear people try to talk about Bitcoin being a bubble. It's not big enough to be a bubble. And even if the bubble pops, who does it hurt? Little mom and pop investors, somebody who may have, a couple $1,000s invested. Bitcoin doesn't have broader implications of the global economy. If the Bitcoin bubble bursts, it's not going to affect your pension plan. If the Bitcoin bubble bursts, it's not going to affect the real estate market. If the Bitcoin bubble bursts, it's not going to affect the purchasing power of your money. It just bursts. Understand the difference. Big difference. And this is why you want to be in assets that are outside of the traditional financial system. Because now, look what the Bank of Japan is doing. The Glass-Steagall Act was created to prevent another crash. Clinton repealed it in 1999. The stock market is a casino. Gold standard has to come back. I'm going. Thank you for the donation of $4.90 for $5. Greatness 81. I'll definitely get to that later on about the gold standard and why we're never going to go back to the gold standard. And I'll get to that towards the end of this video. But let me read this article to you. And it says, BOJ, the Bank of Japan reassurance on coronavirus bolsters speculation of global policy action. It says, French Finance Minister Bruno Le Maire, or Maire, also said on Monday that G7 major economies would take concerted action to limit damage from the epidemic, with the group's finance ministers to discuss the best approach by phone this week. So they're talking about getting together, the G7 countries, to stimulate the economy. Kuroda said financial markets have made unstable movements amid heightened uncertainty over the impact on the economy from the epidemic. The BOJ will monitor developments carefully and strive to stabilize the markets and offer sufficient liquidity via market operations and asset purchases, he said. What does that simply mean when they say market operations, liquidity, asset purchases? Printing money, going into the markets, taking away price discovery. So now we don't know what these stocks are really worth based upon fundamentals. So as an investor, you can invest based upon whether this company is more competitive, if they have a better product, if they have better services. You have to think about what 12 men and women are going to decide the cost of money is going to be, who they're going to bail out, what sector they're going to invest in, what new crazy scheme are they going to come up with to stimulate this sector versus that sector. That's not capitalism at all. Centrally planned markets that's not capitalism. It says the statement's language suggests the BOJ would make full use of its existing tools to flood markets with funds before pondering additional monetary easing steps. They're telling you this. They're telling you in blind. This is why you own gold and silver. This is why I own crypto. The statement's language suggested the BOJ would make full use of its existing tools to flood markets with funds before pondering additional monetary easing steps. Indeed, the BOJ subsequently offered 500 billion yen, that's 4.62 billion, in 2-week funds via market operations, printing money. Investors also expect the central bank to ramp up daily purchases of exchange traded funds to put a floor on stock prices. There's no price discovery. Going to the definition again, that's not the free market operating. Price discovery refers to the act of determining the proper price of a security, commodity, or good or service by studying market supply and demand and other factors associated with transactions. If the Bank of Japan is going into the stock market and they're buying up the ETFs to put a price floor underneath their assets, then you can't invest. That's not a healthy market because now bad companies are being rewarded. Kuroda's statement focused on market operations and asset purchases, which meant the BOJ may make its ETF buying more flexible to support stock markets or take steps to avoid money markets from tightening, said Yorisha, I don't even know how to say it, I'm just going to say Yoshi, chief economist at SMBC Nikko Securities. Now, again, I like to bring you guys the information right here. This is the federalreserve.gov. The Fed is doing the same thing. This is why I said we may not see a stock market crash like 1929 because the Fed may just go into the stock market and start buying ETFs and buying stocks, but at the expense of inflation. And this is why you have to be able to understand that they may go out here and start buying assets, at the expense of basically just saying they don't care what they do to the value of the dollar because they need to save the economy, which is why you need to be a 3-dimensional thinker and just think a little bit, outside of, what you are used to. Give me 1 second. I want to pull up something. Right? I always bring up this for you guys. For some reason, it's not coming up. There we go. This is the purchasing power of the dollar. Right? So when the Fed creates money out of thin air, when they go into the markets, when they intervene into the markets, when they print trillions of dollars, when they cut rates, when banks do fractional reserve banking, repo markets, ZERP, all of these different operations and programs, this is what happens to your purchasing power. From 1913 up into 2013, and now we can extend this to 2020, the dollar has lost 90% of its purchasing power. It's still a dollar, but it buys less. It buys less. So we're going to see dislocations in the economy where you're going to see, everything's fine. Look, the stock market's up, but everyday Americans, they don't feel that benefit. They don't feel that boom. Now, here you see the Board of Governors of the Federal Reserve System. Right here, it says, this is the Fed going into the market and buying assets. The Federal Reserve's balance sheet has expanded and contracted over time. During 2007-2008 financial crisis, the subsequent recession, total assets increased significantly from $870 billion in August 2007 to $4.5 trillion in early 2015. And then it declined to $3.8 trillion, and then they started buying assets again. I want you to think about that. Think about that. Notice how I keep throwing around trillion dollars here, $1 trillion there, $1 trillion there, and they're just going to keep printing more and more money. Now, going back to what I was talking to you about the other day. I mean, not just the other day, but earlier in this live stream when I was talking about how the market begin to actually take off when the Fed start going into the repo market. And we're starting to see the Fed going into the repo market again now, which is why the market is starting to go up. It really doesn't have a lot to do with interest rates. And you're going to start to hear a lot of silly people come out and say things like, oh, well, people are going to get lower rates on their mortgage and credit cards are going to be, the interests are going to be cheaper. No, they're not. Excuse me, most of you know with credit cards, your interest rate is 22%. Banks really don't like to lend out money to regular everyday people. And a lot of people don't have good credit to get loans anyway. You basically got to give up your blood and your firstborn to get a loan from a lot of these banks for most people, because many of you don't fit the criteria to get an actual loan from the bank, which is part of the problem, which is, again, the money doesn't circulate and flow through the economy. Now, I want to read this article. I don't know, where did it go? Here we go. So this is from today. It says the Fed's 100 billion repo intervention falls short of bank demand. Basically what the repo market is basically banks, they lend money to each other and they have an interest rate. Well, something was happening back in October where the interest rate spiked to like 12, 13, 14%. Basically, one of those banks were insolvent and they didn't have enough cash. And banks didn't want to loan to them. So the Fed had to come in, print money out of thin air, and start going into the repo market. But they have a cap of $100 billion. It says the Fed 100 billion repo intervention falls short of bank demand. So $100 billion isn't even enough for the banks to operate overnight. Think about that. The banks are bankrupt because they print money out of thin air. And when asset prices fall, those assets are worthless. They literally print money out of thin air. I'm going to read a couple passages and I'm going to get to the data. It says big banks demand the central bank cash remained. It says big banks demand for central bank cash remained very strong on Wednesday, leading the Federal Reserve Bank to add a fresh 100 billion to the financial system. Add a fresh 100 billion to the system. What does that mean, ladies and gentlemen? Print more money. Print more money out of thin air. This isn't complicated. The Fed added the money via what's called an overnight repurchase agreement operation, or repo. Eligible banks, called primary dealers, sought $111 billion from the central bank, exceeding the $100 billion cap the Fed places on overnight repos. Why do I want to own gold and silver? What do I keep hearing? This person gets 100 billion. This person gets 100 billion. This person gets $1 trillion. $14.5 trillion here. $253 trillion here. Do you start to see that there's a problem with the system? Just Living said, I hit you with a PayPal donation. Your work is appreciated and informative. Thank you so much. The heavy demand for the Fed cash reprised the strong interest seen for Fed money on Tuesday when the Fed added even more money to the financial system. As of Wednesday morning, the total amount of Fed repos outstanding held steady from Tuesday at $195 billion. Repo outstanding levels have been falling over the recent weeks, but have ticked up over the last 2 days, although they are still short of the $255 billion that was outstanding on January 1st. Now, you can actually go see, guys. I don't guess when I say this stuff. You can go to the Federal Reserve Bank of New York, and you can pull up the data right from. They put the information in your face because see, they know most Americans are deaf, dumb, and blind, and they also know most of you don't care. And when I say you, I'm not talking about those of you viewing the content. Obviously, those of you watching the content, you care. That's why you're watching this content. Most Americans don't care about where their money comes from. Most Americans don't care about what the government is doing. Most Americans won't take the time out with their smartphone. Right? This is not like in the 60s and the 50s when people didn't have computers. You can literally go into your smartphone and actually see what's going on your smartphone. You can pull this information up. Now, this guy said stocks versus gold, though. If you price the Dow in gold, The Dow's actually losing money. If you price the S&P in gold, the gold is worth more than the S&P if you price it in real money. See, that's the problem. You pricing stocks in paper money. You're not pricing it in real wealth. If you go, again, don't take my word for it. Go and do a side-by-side comparison and price the actual market in gold. I'll do it in a future video and show you. If you price the Dow in gold or you price the S&P in gold, gold is worth more money. It's outperformed those markets. But I don't want to get distracted. So right here, you can pull up the Excel spreadsheet. I don't want to get distracted because I'll go off on a tangent. So this right here, I downloaded the Federal Reserve data. Give me 1 second. The Federal Reserve Bank of New York data. Right. You can go here and you could pick the dates, and then right here it shows you, like today, for example, the total is $111 billion, like the article just said, and it says it to you right here. The deal date is Wednesday, March 4th, 2020. Delivery date's Wednesday, March 4th, 2020. Maturity date is March 5th, 2020, and it shows you everything, right? And then now you can pull up the actual spreadsheet. You can go up here and you can download this data and you can see this for yourself, right? So then now when you go here and you pull up the Excel spreadsheet, you can see this corresponds with the actual date. So you can see I have all of the dates here. 3/3, 3/2, 28th, 27th, 26th, 25th. And I go all the way back to when the market started to break out, because the market's not going up because of fundamentals. It's not going up because of Trump's strong economy. Look at this. This is $1 billion, right? 53 billion, 80 billion, 83 billion, 75 billion, 65 billion, 62 billion, 80 billion, 91 billion, 72 billion, 50 billion, 49 billion. Look at this. $53 billion in a day is what they're pumping into the banking system. $80 billion, 83. Just go up the list. So when you see this market break out, just think about how big those numbers are. This is per day, guys. This is per day. 53 billion, 80 billion, 83 billion, 75 billion, 65 billion every day. They're pumping billions of dollars into the banking system to keep the system afloat. The system is falling apart right in front of your eyes. You don't have to be a rocket scientist to see this. Look at this. Go up here. 89 billion, 77 billion, 76 billion, 47 billion, 59 billion, 59 billion, 72 billion, 31 billion, 73 billion, 77 billion. Over and over again. Right? Now, look, someone said that's too many billions of dollars in the repurchasing market to say that's everything is okay, because it's not okay. It's not okay. They put it right here in your face. You can go here and get this information on your own. Now, some days they may skip a day or two, right? They may skip a day or two. And I'm glad that the guy said 100 for show, because now when you actually come here, this goes back to this chart. Why I was showing you guys this chart, and this is important that you understand this. Give me 1 second. Let me pull up this other chart for you, because now you will understand U.S. household debt. No, I want to pull up this chart for you guys. Add a line. Give me 1 second. Pull it up for you so you can see what I'm talking about. I have to add it on the other side. The ratios. Edit line 1. Give me 1 second. Select. I can't pull it up right now. I don't want to get distracted. So now, a lot of you, somebody left a comment the other day and they were talking about, because I have to find this chart. So I'm going to play this video for you guys while I look for this chart. So a guy left a comment the other day and he said, why would you want to own gold and silver when the government can make it illegal and confiscate it? Because the government actually did do it before. And I said, you know what? That's a really good question. Number one, they didn't confiscate it. They nationalized the gold, right? Because they actually paid you for turning your gold in. It wasn't like they just came and took it from you and didn't give you anything. If you turned your gold in, I think it was Franklin Delano Roosevelt who did it. Yeah. He basically outlawed gold and he had to come and redeem it. Number one, that would never happen today. Because think about it. Here in New York, to own a gun is illegal, right? But people still get shot and people still own guns. So just because something's illegal doesn't necessarily mean that people are going to actually follow the law. But I want to play this for you. This video is from April 5th, 2013, and I'm going to explain to you why that may happen and how you can protect yourself from that happening to you. So give me 1 second. Let's put this on.
80 years ago today, the day the federal government took all our gold, it changed the precious metal as we know it. So let's start with a little history lesson. April 5th, 1933, FDR confiscated every gold coin, bullion, and certificate. People had to basically turn in their change the precious metal as we know it. So let's start with a little history lesson. April 5th, 1933, FDR confiscated every gold coin, bullion, and certificate. People had to basically turn in their gold to the federal government. If not, they face up to 10 years in prison or a $10,000 fine. That's almost $179,000 in today's money. Now, you were able to keep a small amount or rare coins, but those who did give up their gold got about $20 an ounce. So why did the government do this? Well, to prevent hoarding, devaluing the dollar.
Did you hear what she just said? Devaluing the dollar. They're telling you this in your face. So when you trolls come on here and tell me, oh, why do you want to own gold and silver? It doesn't do anything. Why do you want to own gold and silver? They're telling you this in your face. That they want to devalue the dollar. They're literally telling you this in your face. This is not guessing. This is not me making up a conspiracy theory. I'm showing you the data of them printing billions and billions of dollars. I'm showing you the data, the articles. They're saying $253 trillion of global debt, $14.5 trillion of household debt, $74 trillion in the banking system. I'm literally showing you the information. They're putting it here in your face. They're telling you they want to devalue your money. So now it's up to you. Are you going to continue to keep playing by the rules where they're telling you that they want to basically take your wealth away? You're trading your most valuable asset, which is your time, for pieces of paper. And they're telling you that inflation is too low. 3% isn't enough. They want to create more inflation. They want to devalue the dollar more, not to help you, but to bail out a bunch of rich bankers, to bail out a bunch of Fortune 500 companies so that they can continue to keep getting rich and so that you can stay poor. You buy gold and silver as a hedge against inflation to preserve purchasing power, and then you speculate in assets that are going to pay you faster than inflation. Now, Sonic Strange made a very good point. Bitcoin is also being hoarded. It absolutely is being hoarded. People hoard things that are worth money. I want to store my precious metals. I want to hoard my precious metals. Why do you think it's called a precious metal? Because you're trading your time for money. I don't want to give up my money for pieces of paper that's going to lose at minimum 3% every year. And that's if you trust the government's data. So yes, that's the whole purpose of saving money. I want to hoard my gold and silver because I'm saving my money. Why would I want to put $10,000 into a bank account and lose at minimum 3% when I can put my money, right? If you put money in a savings account, that's hoarding too. See, people don't think about this for a second. And I'm not talking about you, Sonic Strange. I'm just talking in general. I want you to think about this. When you put your money in a bank account and you save money for 5 years, 3 years, you're hoarding dollars. Right? You're saving money in your bank account. You're hoarding money because you're saving money for a rainy day. The problem is when you put that money in your bank, it's losing value. The value of that money, it's still $1, but it buys less. What I'm saying is that I want to, just like I hoard my money in a bank account, I want to hoard my money in precious metals. I want to hoard my money in precious metals. Is what I want to do. I hoard money in precious metals. And I'm going to play this video for you again. But before I do that, I finally got this chart that I wanted to show you. This is the problem with the system and why the system has to be changed. Because when they do bailouts, this is the money supply, right? M2 stock. This red line is the money supply. This is the actual money that's in the system. This is physical cash, right? That's in the banking system. The problem is this blue line shows the velocity of money, meaning how does money move in your economy? Here's the problem. Look at it. The money's move is going down. Money doesn't circulate in the economy because all of the money is stuck in the system. And rich people, they don't spend money, they hoard or they reinvest it. So all of the money is stuck in, like when Trump gave the rich the tax cuts, they didn't take that money and go out and stimulate the economy and hire more people. No, they brought back their stock. That money stays in the financial economy. It doesn't get into the real economy where you and I are at. So you can see the blue line of the velocity of money. It doesn't move in the economy. It just stays in the financial economy, which is part of the problem. So let's go back to that video.
Years ago today, the day the federal government took all our gold, it changed the precious metal as we know it. So let's start with a little history lesson. April 5th, 1933, FDR confiscated every gold coin, bullion, and certificate. People had to basically turn in their gold to the federal government. If not, they face up to 10 years in prison or a $10,000 fine. That's almost $179,000 in today's money. Now, you were able to keep a small amount or rare coins, but those who did give up their gold got about $20 an ounce. So why did the government do this? Well, to prevent hoarding, devaluing the dollar during the Great Depression. And then the Federal Reserve set the gold price at $35, pegging the dollar to the commodity. But this could never happen again, right? Well, tell that to Texas. The state is contemplating a bill to create the Texas Bullion Depository to protect its own gold. The state would abandon its storage in New York and move their gold stateside. And if the government comes for it, Texas is prepared to fight with the 10th Amendment, arguing that states' rights trump any confiscation order by the Fed.
And again, this is what I try to tell you guys. Think about it. If gold was worthless, why would states want their gold back? If gold was worthless and it didn't do anything but just sit there and look shiny, why would the central banks be buying tons and tons of gold? See, this is the question you have to ask yourself. Every fiat currency in the history of money has failed. Every fiat currency in the history of money has failed. Every fiat currency in the history of money has failed. And what's always remained as money has been gold and silver. Now, the link I just put into the chat for Just Living, that video, I show you how you can go and buy cryptocurrency. I have it there. So right there, go ahead and you can watch that video and I'll walk you through step by step how you can go set up an account and buy cryptocurrencies. I recommend doing dollar cost averaging. This is not financial advice. I'm simply just sharing with you how I look at buying assets. I like to dollar cost average. Therefore, I don't care about the price going up or going down, right? I just buy on down days. I buy on pullbacks. I have price levels as to where I want to buy, where I want to buy at. Again, this isn't financial advice. I'm just simply telling you how I invest. I look at it this way. You have a savings account. Now, let's take a step back, right? If you're poor, this is not for you. I'm not telling you. This is for people. If you have a 401k, you have an IRA, you can buy precious metals in your IRA. Now, you have to worry about counterparty risk, right? Because you're buying the paper version of it. So you have to worry about, does the actual ETF or whatever investment vehicle you're investing in actually have that physical gold, Or are you really just, playing into the paper game? Like, just like they can create dollars out of thin air, they can create paper certificates out of thin air for that gold. But just follow me here. If I have a retirement account, right, I have a portfolio, right, I have $100,000. This is what I would be thinking about doing. Okay, 20% of my retirement is going to go into precious metals because I want to preserve purchasing power, right? Then let's say 40% is going to go into, staple companies, like things that people need, consumer goods. A company like, Procter and Gamble, Walmart, companies that are like big companies, things that people need, toilet paper, toilet tissue. Like right now, you're seeing Costco break out. Costco's breaking out because guess what? If this virus spreads, people are going to be running to those places and stocking up on goods and services. So I would want to have 40% of my assets in dividend paying stocks into stable companies that pay out a stable dividend. They're not growth based. They don't make a lot of, they're not going to get you huge gains. They're not going to get you 10, 20% gains as far as the price appreciation, but they're going to give you actual cash flow as far as dividends is concerned. And then I would have 10% of my money into heavily speculative companies like a Tesla, like a Chipotle Mexican Grill, like Facebook, companies that can Qualcomm, chip manufacturers, because think about it, everything has chips in it today. So I want to own a company that actually makes microchips. I want to be invested in it because technology is going to rule the world. So I want to be invested in it. I want to be invested in things like water, things that people need. Most of the world doesn't have clean drinking water. So I want to be diversified and balanced in my investing. See, the problem for a lot of you is you're overweight one particular asset class. So therefore, now when stocks fall, you get scared because your entire pension 401k is tied up into the stock market. And you don't really have any alternative assets outside of just, typical stocks. And that's one of the biggest problems. See, I don't panic because real estate is my cash flow. Real estate sustains my lifestyle. Right? So now think about this, right? When I look at it, real estate takes care of me on a monthly basis. The cash flow that I get from my real estate, that takes care of me and my bills where I currently live, right? And then I take the money that I make from my businesses and I invest that and I speculate into assets that are going to appreciate in price faster than inflation. So when I look at something like Bitcoin, that I've been investing in Bitcoin back when in the single digits, but like for the past bull run, I've been heavily buying from 700 up to 3,000. So when Bitcoin's trading at 8,000 or Bitcoin hits 20K or 30K, I'm 5X in my money. I'm 10X in my money. So that's how I look at things. There's cash flowing businesses. Even with real estate, you get the appreciation through inflation. So there's things that you have to think about when you're investing. So this is why it's called personal finance. You have to find what works for you. And that's very, very important. But you can't deny that they're telling you just saving money and holding money, they're going to kill you. They're 100% going to kill you over and over again. Now, Robinhood had a problem the other day, and Mark J corrected me because I was comparing Robinhood to I got Robinhood confused with what's that thing called, the app, Cash App. Cash App allows you to purchase crypto. You could buy Bitcoin on Cash App. And you can actually get your physical Bitcoin, well, not physical, but your Bitcoin, you can transfer it into your wallet so you don't have to leave it on the exchange. There's something known as counterparty risk when you are investing. So when you have assets that are on certain platforms, you need to make sure that these platforms are, that they're stable, that they're solvent, that they actually have the assets to back it up, because people are trying to sell and get out of the market, or they had short positions and the market was rallying and Robinhood had an outage and people couldn't trade. So if you were stuck in a bad position, like if you were shorting the market and the market's up 1,000 points and you can't get out, you're stuck. Well, that's the same thing with crypto as well. We have a saying, not your keys, not your Bitcoin. So when you're using exchanges like, Coinbase, you need to get a hardware wallet or get a paper wallet or some type of third-party wallet. I think Electroneum is not bad either, but a wallet where you can control the keys. You don't want to have counterparty risk, and that's the same thing with gold. I don't want my gold, I don't want to own paper gold, because if you have to ever call that gold, it's going to be a problem if they don't actually have the gold to back up the ETF, or the gold to back up whatever type of product that you're investing in. And I want to show you what I'm talking about right now with HSBC, because I spoke about this other day, and then we're going to get to why we're never going to go back to the gold standard. But I just want to show you something real quick. So this right here is HSBC. This is counterparty risk. This is the same as what's happening with Robinhood, but just in a different asset class, right? So HSBC plans to cut 35,000 jobs. This bank is basically bankrupt, but they are the largest holder, right? They're the custodian of the GLD ETF. So when you own the GLD, you don't actually own the underlying asset. You own something that's trying to mimic the price of gold. But the problem is, do you really think that they actually have the gold on hand? Like, if you actually had to audit HSBC, this is a bank that's bankrupt. This is a bank that's known for fraud. Do you honestly believe that they have the actual, that you think that they actually have the actual gold on hand? I doubt it. And this goes back to why the gold standard will always fail. Somebody said, bro, I need your Cash App. My PayPal is in the description below if you want to donate. Mr. G said Coinbase is okay for when you first get started. But again, if you're investing big amounts of money, like for someone like me who manages money, I can never leave my crypto sitting on an exchange. Just doesn't. But again, if you're just starting, like Mr. G said, it's okay to just buy your crypto and leave it there and learn. Take the time out to educate yourself about things. Guys, don't buy anything that you don't know, that you don't fully understand. If you don't understand gold and silver, don't buy it. If you don't understand particular stocks, don't buy them. If you don't understand crypto, don't buy it. Do not buy something that you don't understand. There's 200 of you guys watching. Please hit the like button. It helps the content rank in the search engine. So now, the next thing I wanted to say is about the gold standard. The problem with the gold standard and why we will never go back to the gold standard is it's very simple. Gold is hard to move around, right? It's too clunky. It's too big. Gold is meant to store wealth. It's meant to be hoarded, which is why the goldsmiths and the bankers always were able to inflate the currency with the gold standard because, people don't come and check on their gold often. So basically what they would do, they would create more paper certificates than actual gold they had on hand, because most people don't actually come and redeem their paper certificates for the gold, because think about it, cash is more portable. Could you imagine, like, if you carrying around $5,000 worth of gold? Right? It's not feasible in a modern society, right? So this is why cash was created, because it's more mobile. It's easier to do business with cash. It's more simple. And then now we live in a digital economy where everything's digital, where, I can buy a product all the way in Germany. I don't have to worry about, could you imagine if you brought something with gold? You would have to then ship the gold all the way to Germany. You purchase something on Amazon. If you got something from AliExpress or, from California, it's just not easy to do commerce with gold, because you have to always trust a third party. And as we can see, it goes back to trust. I don't want to have to trust a third party. You can't trust your government. Your government's showing you that they're not trustworthy. You can't trust any of these companies, because the government can always go there and hold them hostage and confiscate it, or they can get greedy and create more paper certificates than actual gold deposits. So this is why gold, it's a good store of value. It's a good hedge against inflation. But as far as being a currency, a good medium of exchange, gold is just not a good medium of exchange, because it's hard to exchange it. It just is. That's just the reality, which then goes back to crypto. See, when you're dealing with Bitcoin is digital. It's a digital form of money. So it's easier to exchange it with other people. Well, I don't care if it's Ripple, whatever crypto you're into, Ethereum, Ripple. That's the value proposition of most cryptocurrencies that are trying to be a medium of exchange, is that it's portable, right? It's durable, and it's easy to exchange it. So with the way society is structured, we're just never going to go back to a gold standard. Now, that doesn't mean that gold isn't a good investment. Gold is meant to be a store of value. Keyword, store of value. Store of value. You are meant to store your purchasing power in gold and silver. Currency is used to exchange. It's a medium of exchange. It's not meant for storing wealth. It's meant to exchange goods and services. That's the whole purpose of currency. So it's important that you go out and you study what money is and different forms of money and the pros and cons of different forms of money. No, you just go, okay, so somebody, OG, could I buy a home with gold coins? Of course you could. You can convert your gold into whatever currency that exists. So right now, if I'm in Europe, I can go to a bullion dealer and sell my gold at spot price and just get the cash. That's the whole purpose of gold and silver. Like, no matter what currency exists, I just convert my gold into that currency. So whether it's euros, whether it's Swiss francs, whether it's the Kiwi dollar, I just convert my money into that local currency or that national currency. Not complicated at all. It is the same thing with Bitcoin. Like, I can convert Bitcoin into whatever currency that exists. See, I want my money to be outside of the system. I don't want my money to be debased and devalued. So I store my wealth in gold and silver, and I just convert it into whatever currency I want to convert it into. You know, it's not really it's not complicated at all. Now, again, like I said, if you don't have wealth, then you shouldn't be worried about this stuff. You should be worried about acquiring more skills to accumulate more wealth. That's something that you personally have to figure out. But this is why I like to personally, physically hold my assets, because of counterparty risk, because I just don't trust that any of these actual banks or services that are meant to hold our, precious metals are actually going to have them when you need them. So let's look at some of the questions and see what's in there. Electronium is a good wallet. I would say but I would recommend that you guys listen. Get a hardware wallet. I'll show you guys right now. This is, in my personal opinion, this is the best wallet to get. Give me 1 second. I have a video on it right now. Get you a hardware wallet. There's plenty of videos on YouTube that show you how to use it, how to set it up. It's not that complicated. But get you a hardware wallet. But understand, guys, this is going to take you time to learn this stuff. This is why I want to create the Patreon and take out the time to educate you guys, because this is important information, but it's technical stuff of onboarding people to this. A lot of people don't think about this. Many of you don't even know how the US dollar works. You don't even know how the Federal Reserve works. You don't realize, many of you don't even know what the repo market is. Like, if I came to you 2 weeks ago and I asked you, what's the repo market? You have no idea. If I sat up here and I talked to you about the Fed is pumping $49 billion, $48 billion, $59 billion, $64 billion, $47 billion. Every day, they're printing billions and billions and billions of dollars and injecting it into the financial system. You would say, what the hell are you talking about? You would have no clue what a repo operation is or what a repo agreement is. Many of you still don't. Rehypothecation, you wouldn't know what that is. Debt monetization. Many of you, quantitative easing, you don't know this stuff. So it's, you can't go from not knowing how your own money works to thinking that you're just going to learn about crypto in one day. It takes time. There's so many things about crypto I don't know. Like, when you come here and you look at this, and let me put this in the chat for you guys. This is known as a hardware wallet. This is the company. They sell ledgers. Remember, guys, I give you a template. I give you but look at this. All of these are different blockchains. Bitcoin's a different blockchain than Ethereum. XRP is a different blockchain than Ethereum. Bitcoin Cash is a fork of Bitcoin. Bitcoin SV is a fork of Bitcoin. USD Tether is a stable coin. Litecoin's a different blockchain. EOS is a different blockchain. And they all serve different purposes. So this is why I say to you, like, find a cryptocurrency project that you personally like. Me, I like Bitcoin, because I understand the technology and I understand that it's decentralized. No central entity controls it. And I'm going to show you real quickly what I mean by that. Let me flip over to the iPad so I can get you guys to understand why I personally like Bitcoin as far as being money is concerned. Right? When you think about centralization versus decentralization, that's what we're going through right now, right? When you look at the way our economy is structured, everything is centralized. Like, it's called the central bank. You have a group of people, a single entity that basically can say what you can and can't do. They are basically centrally planning how much money is going to be worth, where the money is going to flow, where the money's not going to flow. Those type of systems are inefficient, and those type of systems are antiquated and outdated, and they are easy to commit fraud and defraud people in. So when I say centralization, give me 1 second, right? Let's look at YouTube, for example, right? Here you have YouTube. This is where all of the executives sit. This is where all of the leadership sits. And then you have people who use YouTube, right? These are all people who use YouTube. But the central point of failure is here. It's centralized. If YouTube doesn't like what you say, if they don't like your videos, your speech, they just cut you off and you have no say. It's a central point of failure. PayPal is set up the same way. PayPal can freeze your funds. They are a middleman. They are an intermediary. Your bank, central point of failure, centrally planned, centrally controlled. They control your money. They can freeze your funds. They can shut your account down. Right? Then you have decentralized distributed networks. And that's what Bitcoin is peer-to-peer. So, therefore, rather than one person controlling it, it's distributed. So you have a bunch of nodes everywhere. All of these people are distributing the information to one another. So each person has say. Each person knows what's happening. No one person controls the network. It's open source technology. And all of these nodes communicate with each other in a democratic fashion to make sure that no one is doing something that they have no business doing. No one is spending money that they don't have. It's decentralized. So if this person tries to do something that's outside of the protocol rules, it doesn't count because all of these people are working together because it's a decentralized distributed network. It's a flat network. So now you don't have to worry about trying to send money to this bank and they say, we don't like what's going on here with your transaction. We don't like what you're trying to do. So no, you can't do it. No one entity can control it. Therefore, there's no one point of failure. There's no central point of failure. And when you begin to understand the importance of that, that's when it becomes where I don't have to trust. Bitcoin removes trust. I don't have to trust PayPal. I don't have to trust Bank of America. I can just simply verify that this person right here, let's move this, let's erase this. When you start thinking about it, move this out the way. Right? I don't have to trust a third party. I can verify by looking at the actual open public ledger because it's distributed. Everyone has it, right? I can go and actually look at this person and say, does this wallet have 5 Bitcoin? I can actually go look up the information on the blockchain and see, does address 123456 ABC have $5? Right? This person has 5 Bitcoin. Yes. And this person can then now send this person 5 Bitcoin. And you can't fake it. You can't manipulate it. You can't double spend it because it's immutable. It's blockchain technology. There's no central point of failure. No one controls it. There's no middleman in here. There's no one saying, Alice, you can't send $5 to Bob. And then now when you understand, because no one controls it and there's rules to the protocol, now you understand that in each block, every 10 minutes that's created, there will be a block subsidy in it. So I can tell you that every 10 minutes a new block is going to be created. That's why it's called the blockchain, right? It's a bunch of blocks full of transactions, right? Each one of these blocks has a transaction. And if you change something in this block, then all of the blocks before is invalid. So therefore, I don't have to worry about trusting Ben Bernanke. I don't have to trust Obama. I don't have to trust Donald Trump. I can go look at the actual blockchain and I can see all of the transactions that's in this block. I can see all of the transactions that's in this block. It's transparency. It's transparent. So I don't have to guess. Did the Fed create $80 billion? I don't have to guess who's getting bailed out. I can look at the actual blockchain and I can see what's happening because it's an open, public, distributed ledger. That's why it's important, right? And I don't like explaining stuff like this because it's out of sequence, and I know a lot of you guys don't get it. But when you understand cryptography and when you understand the power of decentralization, you can really start thinking about the broader implications on things. Like you can really start putting things together. A blockchain is just a chain of blocks. That's all it is. Right? Bitcoin can become stolen. For example, okay, you have a public key and a private key with Bitcoin, right? So let's say your public key is 1, 2, 3, 4, 5, 6, right? Your public key is like your email address, right? That's what you give to people who you want to actually send you email, right? And then you have a password. Well, in cryptography, your password is your private key. So, right, this is your public key. We call this PK, right? And then now you have your private key. Your private key may be 6, 5, 8, 9, 23, right? This is your private. Let me write this better. Let me take my time and write this for you guys, right? Then you have your private key. Obviously, your private key, you want to keep your private key private because your private key is basically how you're going to sign transactions. So when you send me money, I know that the money came from this public address because only you have access to the private keys. Now, the beautiful thing about this is that you are synonymous. You don't need any identification to create and get a Bitcoin address, right? It's not anonymous, it's pseudonymous. So if I want to send you money, I would say, hey, Jason, I need your public key. You give me your public key and then I send you the Bitcoin. Now, your Bitcoin becomes stolen because if you let somebody get a hold of this key, then I can access your wallet and I can access your funds, which is why you hear me say, not your keys, not your Bitcoin. Not your keys, not your Bitcoin. So just look at it as an email address. Your public key, that's the address that you're going to give people, that you want everyone to see. Your password is your private key. You don't want anyone to get the private key because if they get the private key, then they can intercept your email and hack your email, right? So it's important that you understand that. Now, there's an hashing algorithm because Bitcoin is made up of functions and cryptography, right? So the function is SHA-256. Because see, with your email address, you pick your email address. Well, in Bitcoin, the algorithm is going to hash it. And again, like I said, I don't want to get too technical, but just do the math. If you go 2 to the 256, like the chances of you and another person getting the same public key address is basically it's infeasible. Like there are more public addresses than there are atoms in the actual universe. You can track the person who actually hacks you because that goes back to, remember, it's a public blockchain. So let's erase this. You can actually track the person. The problem is, well, let me fix that. You can't track the person, but you can track the address. You can't track the person, but you can track the address. And if the person uses like a Coinbase or a Bitfinex to, like, they basically catch you on the outside. Like wherever you convert your Bitcoin into cash at is where they're going to catch you, because Coinbase has a policy called KYC, right? Know your customer. So in order to create an account with Coinbase, you have to upload your ID and stuff. And this is how people get caught when they hack and steal funds. Again, I'm not going to tell you how you can avoid that because, you know, I don't want to get in trouble legally. But remember, each transaction is technology. You have inputs and you have outputs. So all you have to do is, if you have the person's public key, remember, if you have public key 1, 2, 3, 4, 5, 6, that is going to be in this block, right? You're going to be able to look in the block and see this public key spent inside of this block because it's an open public ledger. And it has inputs, so you can see the inputs that came in and you can see the outputs that came in. And this is how you can track people across the blockchain, because remember, every block is connected. Every block is connected. And you can go all the way back to the Genesis block, the very first block that was mined, and you can see all of the transactions that happened in there. So all you have to simply do is just follow the address, and you can track where the money went and where the money stopped. And then you can see, okay, well, he sent money from this address, and then he sent money to this address. This address could be 4, 5, 6, 7, 8. And you just track a person. Very simple, right? But again, I don't want to get too technical without giving you context. I just wanted to answer a few questions because it can become very confusing. When I first came across this, I didn't get it either. It was very complicated to me. Just look at it this way. Again, I'll give you the same thing I gave you before, right? Just follow this. You have centralization and you have decentralization. Centralization is one point of control, right? One point of failure. YouTube is a centralized platform. They say what you can and can't do. They say what you can and can't say. And if you say anything that they don't like, they get rid of you. Decentralization says, rather than giving power to one entity, we want to give power to everyone. See, Bitcoin is basically a combination of multiple pieces of technology. But Satoshi, or the group Satoshi, was able to put everything together in one place. And this is why, like I said before, when I create the Patreon, I want to be able to put the information together for you in a step-by-step fashion, rather than, you know, confusing you and explaining stuff to you like that. Because again, if you understand cryptography, then you would understand the power of having a ledger like this. Because see, in Bitcoin, we don't have to trust, we can verify. Like I can look up your public address and I can know that you have the funds to spend. I don't have to guess if you actually have the money. And if you try to spend money that you don't have, the nodes are not going to accept your transaction, right? Because they're going to verify and look at your inputs and your outputs, and they're going to say you don't have those funds to spend, and they stop it. Like they did to Alex Jones and Farrakhan. Exactly. They can say to you, you are creating hate speech, right? So you have all of these people, and all of these people are people like you and I. You know, they're content creators. All these little circles, they're content creators. Well, YouTube says, you know what? We don't like Eli. We don't like Alex Jones. We don't like Farrakhan. Get rid of them. And just like that, they get rid of you. In a decentralized network, they can't do that because no one person controls it. So no one can ban you. And see, this goes back to companies like Ripple. Companies like Ripple, in my personal opinion, they're not decentralized because there's an entity, there's a company behind it, like Ripple Labs. So I don't really look at projects like Ripple as being decentralized. Now, that doesn't mean that it doesn't have utility, but to me, it takes away from the aspects of the whole purpose of the technology, right? It's like you're basically leaving one set of masters and rulers to go to another. A 51% attack is unfeasible. It's never going to happen. Because what you have to understand about mining, guys, right? You have to buy the equipment. And then you have to, not only you have to buy the equipment, but then you have to spend the electricity hashing the block. Well, Literally, they're spending millions and millions of dollars of electricity. So what you would have to do is you would have to be able to, one, capture 51% of the network and be able to mine faster than everyone else that's creating new blocks to create a new blockchain. It wouldn't make any sense, because if someone could do it, they would have already done it. Right. And then it's $161 billion there. If they really wanted to do it, they would have did it. It's not going to happen. It's infeasible. Like, because they would have to mine enough blocks to basically make it financially rewarding to do a 51% attack. Like, even if they attack the network for 2 minutes, they would have to sustain a 51% attack for 10 minutes. Now, remember, there's the incentive mechanism, right? Like, when you buy mining equipment, you've invested money. So you don't want to break Bitcoin, because if you break Bitcoin, then you're not going to make the money back on the equipment that you purchased. Bitmain in China controls the most hashing power. It doesn't matter who controls the hashing power. It's the incentive mechanism. You're incentivized to do the right thing, because if you try to do something wrong, if you try to capture 51% of the network and you don't capture it, you just wasted millions of dollars of electricity. So it wouldn't make any sense to do so, because if they could do it, they would have done it already. Right? Think about it. Let's flip over for a second, right? Because, you always hear people talking about, China and mining. There's $161 billion here. If they could have done it, they would have did it already. If they could have did a 51% attack on Bitcoin and captured 51% of the hashing power in the network, then they would have done it. But by doing so, you basically are destroying your asset, because if you're not successful in the 51% attack, you spent all of that money on electricity and you wasn't able to roll back the blockchain and create a faster one. So it wouldn't make any sense. But again, like I said, I don't want to get too technical, because I don't want to confuse people, because I understand that this is new technology. But this is why, going back to our original point, when you see stuff like this, where is it at? When you see $253 trillion worth of debt, when you see the Fed cutting interest rates and printing money out of thin air, this is why you want to be outside of the financial system. This is why you want to have alternative assets. We are living in the 1920s. We are in our roaring 20s right now, and we are heading into the end. And in my personal opinion, I believe that we are going to see a recession within the next year. And I also believe that we are going into a depression. And I'm not saying this to scare you. I'm saying this to inform you. I could be wrong. But one thing about history is it repeats itself. I mean, it doesn't repeat itself, but it damn sure rhymes. And I said that earlier, and I truly, truly believe that's what we're seeing right now. Because, again, when you look at this, and I read this earlier, and I'll read it again. During the 1920s, the U.S. stock market underwent rapid expansion, reaching its peak in August 1929, after a period of wild speculation during the Roaring Twenties. By then, production had already declined and unemployment had risen, leaving stocks in great excess of their real value. Among other causes of the stock market crash in 1929 were low wages, the proliferation of debt, a struggling agriculture sector, and an excess of large bank loans that could not be liquidated. Well, we're seeing large bank loans now. We're seeing massive amounts of debt, right? I just showed you this. Global debt is $253 trillion. Global debt. Household debt, $14.15 trillion. Right? I showed you the Fed literally printing money out of thin air. Like, literally, if you go here and you pull up, this is right here, the Excel spreadsheet, and this is the breakdown of all of the liquidity that the Fed is injecting into the banking system every single day. $111 billion, $108 billion, $70 billion, $53 billion, $26 billion. You don't have to have a PhD in finance to see that this is unsustainable and is going to have long-term effects. And again, you can go right here to the Federal Reserve Bank of New York, and you can pull up this information and this data. This is not something that I'm magically creating or, trying to scare you with. We're running a $23 trillion national deficit. Notice how I keep throwing around the word billion, trillion, billion, trillion. This money isn't making it into the economy for everyday Americans like you and I. When you look at this, the velocity of money, most of this money It's just staying in a financial economy. It's not making its way to everyday people like you and I. And there's 200 of you watching this. Please, guys, hit the like button. Hit the like button. It helps the content rank in the search engines. Now, there's trade-offs. There's fiat currencies. It has its benefits. It has its pros and cons. Gold has its pros and cons. And crypto has its pros and cons. This is why you have to find out what works for you and what your personal needs are. Some of you may have IRAs and 401ks, and you may want to allocate some of your capital to a, some type of IRA fund that allows you to put money into precious metals and stuff like that. Some of you may want to be invested in REITs or real estate. You have to find out what works for you, because one thing about a depression, there will be a lot of opportunity. See, you can't just look at it and get scared about the depression and a recession. You have to also look at the opportunities. Assets go from undervalued to overvalued. So when something else is selling off, something else is going up. When something else is going up, something else is going down. And the reason why I personally like crypto, and again, I could be wrong. This is why it's called, you only should be investing what you can afford to lose. Let me say that to you guys again. You should only invest money that you can afford to lose. That's the only thing that you should be investing as far as money wise. If it's your rent money, don't invest. If you got to sell your car, don't invest. It's not worth it. You need to invest in skills so that you could become more valuable in the marketplace, is what you should be doing. If that's what I would be doing, if it was up to me, I would be investing in skills where I can actually command more money in the marketplace, is what I would be doing. But when you look at the market cap, it's $161 billion. Guys, global pension funds have $18 trillion under management, the top 300 pension funds in the world. If the crypto market captures 10% of that, that's $1.8 trillion. I just told you the gold market's $8 trillion. If crypto can capture 10% of that, that's $800 billion, right? This is undervalued. This is grossly undervalued. When you look at most gold and silver mining stocks and you look at the book value, they're grossly undervalued, right? Right. So you have to take the time out to educate yourself about things. And that's what I'm doing day by day. But first, I have to identify the problem. Right. It's called problem, reaction, solution. But we don't want to do problem, reaction, solution. We want to look at the problem and then we want to start focusing on solutions. Because one thing you have to understand is that hyperinflationary depression possible. I need that Patreon University. What you have to understand is that the world isn't going to end. When we had the Great Depression in the 30s, the world didn't end, right? When we had the crash of 1929, the world didn't end. When we had the crash of 2008, the world didn't end. Whoa, JMO, what you just said? You said Jay Morrison announced that the Tulsa Fund is not giving refund redemptions in 2020? Whoa, that's crazy. I have to look into that. Wow, I didn't know that. Jay Morrison announced that Tulsa Fund is not giving refunds and redemptions in 2020. I'm definitely going to look into that. That's crazy. That's crazy. That's crazy. I've never been a fan of Jay Morrison anyway. He's just not my... I think he has some good information, like a lot of his free stuff as far as like credit is concerned. He has some decent information. And that's why I tell you guys, you have to learn how to eat the meat and spit out the bones. But as far as like investing with Jay Morrison, I wouldn't invest no money with Jay Morrison. That's crazy. Whoa. I'm definitely going to have to look into that. So, I'll wrap it up like this. There's 207 of you guys watching this right now. Guys, please hit the like button. Yes, Jay said they only have 1 million in cash left. Did you read his contract? It was not real to begin with. He is fake. Yeah, I'll definitely take the time out and go read that. But guys, you hit that like button for those of you coming in. I'm going to wrap it up like this. I believe that we are at the tail end of our roaring 20s after really looking at the information and studying this. And this is not to scare you. This is to prepare you. This is to get you to become informed. And two things are going to happen with this. Either the Fed is going to continue to keep printing money, as we can clearly see they will do, and cut rates, and central banks are going to continue to do the same thing. And we can see two things happen. Only two things I can see happen. Only two options. Either the market just flat out crashes eventually, and investors come running to gold, silver, crypto, and alternative investments, or the Fed continues to print money and inject liquidity and do operations, repo operations and programs like ZERP, and they do fiscal stimulus like TARP and TALF and all of these different projects that the Fed and your government's going to try to come up with. But at the end of the day, even if they print money and the stock market goes up, it's at the expense of your purchasing power. And I think that a lot of people don't understand that, and this is why I like to take the time out and show you guys that I don't guess. This is government data, and you can see inflation, and this is if you trust the government's numbers. But since 1971, we've been running inflation. You don't have to be a PhD in finance to understand that this is unsustainable. And if it's going to be sustained, it's going to be at the expense of inflation, which means you'll still get paid, but your dollar will buy less. And the information's in your face. So it's really up to you if you can figure that out. Thank you for the donation, Mr. G. I truly appreciate it. KP and who else left a comment? Insanity Cassidy and JMO. I'm definitely going to go get on that and look into that. I didn't know that he did that, and see what it is. But that's enough for today, guys. We'll be back tomorrow, and I'll start diving into like how to buy gold and silver and how to buy crypto and stuff like that, and talk to you about different forms of money. So have a great night. Thank you for tuning in. Thank you for everyone who donated. For those of you who hit up the PayPal, I will shout you out tomorrow at the beginning of the video. So have a great night.